Good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, July the 10th, 2025. Not a huge amount going on, to be honest, guys. So I'll do this a relatively quick one. What we do have today, we do have initial jobless claims. But before we look at that, just have a review of overnight. Not much really. Trump yesterday was threatening Brazil, for example, and other BRICS nations with 50% tariffs just because of just to protect ostensibly American sort of tech companies, and basically saying to Brazil, if they sort of impose taxation on American tech companies, America will in turn increase tariffs by 50%, et cetera, et cetera. So the market, I think, is becoming a little bit desensitized to this. We still don't have anything specific about China, European Union, and the Japan tariffs, which were announced a few days ago, haven't gone into effect yet. And to be honest, most people think they're going to be negotiated. So let's just focus on sort of concrete things which actually are happening. And I think that's what the market is doing. It's looking for data. And just quickly, you can see that next week is really where things will start to heat up, because at this point next week, we're going to start getting Empire Manufacturer, but really it's the CPI. And really the huge debate, which we saw yesterday from the Fed minutes. So we had the Fed minutes yesterday coming out at 2 o'clock. And essentially, it's clear now that there are sort of three camps within the Fed. There are those, and we're just while I'm just saying this for a couple of seconds here, let's just sort of have a look and see what's sort of priced in at the moment. You see, by the end of the year, we've got sort of 2.1 cuts, which is 52 basis points. So nothing for the end of this month in July. And that's the situation. And if we actually just look at how that's developed, you can see that since the non-farm payrolls last Thursday, sort of a week ago, which was sort of ostensibly the market took that as being sort of better than expected. I looked into the numbers in a lot of detail, and I think there are signs of sort of a labor slowdown if you start looking at some of the details. But nonetheless, overall the headline numbers and the broader sort of visible metrics were positive. So anyway, the thing is that the market went from this is the pricing for the end of December, from about 66 basis points, and as you can see now, I've just been trading in a very, very tight range, just kind of summer, very sort of lull, waiting for more data. So as I was saying, on the Fed, it seems from the Fed minutes, there are three different camps. You have the super doves, who's essentially, the two sort of committee members appointed by Trump, who are basically saying that they could see a cut coming as early as July. And as you could see back here, the market is essentially saying that's, a 6%. Mathematically, that's a 6% possibility at this point in terms of the what's priced into the futures market. So that looks more like a political posturing. Then you sort of have other people, on the dot plot, who are basically saying no cuts. And they're the sort of the hawks. And there's a few of those on the hawks saying that they do expect inflation to ramp up, and they do expect the economy and the labor market to remain strong. So that's the second camp. And they're basically arguing for maybe one or maybe no cuts at all. And then you have sort of a centrist group, which is basically saying, okay, we need a bit more data. We think inflation may creep up a little bit, but that will sort of stabilize over a few months. But we certainly don't need to do anything or want to do anything for the next 2 or 3 months. So that group emerging from the Fed minutes yesterday seems to be arguing for a cut maybe, in October and December, or maybe sort of September and December, but nothing more, nothing less. And so that's where we're at the moment. And to be honest, this debate is going to be settled probably by data. And so if we just look at sorry, I just have to move a couple of things here. So if we look at the data, we'll see that what we have this morning coming up is the initial jobless claims. Now, last week, that was pretty good. And again, that came exactly at the same time as the non-farm payroll. So that was sort of a double sort of input of positive data, which is why the bond yields went up at the front end. So we're expecting 235,000, which again is very, very, very healthy and continuing claims. But if we look at, let's say, the 4-week moving average, just have a look at the price graph here, so the chart of that, the 4 weeks moving average, we can see that, in theory, if we go back, it does seem to be sort of moving up slowly. But, again, last week it did move down a little bit, this 4-week moving average. So it's a relatively noisy number. It's not easy to say, oh, this is a straight uptrend or a downtrend, but it does seem to be going up a little bit. And if we actually look at the initial jobless claims, just the raw number itself, let's have a look at that. Again, that does seem to be, just let it load up here, is that going up or down? You could argue that it's simply in a range from, I don't know, 210,000 up to, 240, 250, something like that. But the point is that anywhere within this range, if you look historically, it hasn't changed that much over the last year or two. You can see here, that's where we are. And there are occasional sort of spikes. But essentially, there's nothing, you couldn't really argue with a serious face that that's sort of an upward spike. For the Fed to really be forced to move, even if they were concerned about inflation, they would need to see these numbers, probably going up quickly and regularly to, 280,000, 300,000, 350,000, something like that. And if you combine that with the fact that there's definitely been a fall off of sort of immigration, illegal and otherwise, into the US, and therefore the pool of available labor has shrunk, it does seem that, there's going to be upward pressure in theory on sort of wages, and there's also going to be, just sort of, the participation rate will probably get a bit lower just because there's less available workers. And the fact that there are less available workers probably means that the unemployment rate is going to find it hard to skyrocket just at the moment. So all that to say that, not expecting anything crazy this week, or actually this morning, in an hour or so, just with the initial claims. But definitely that's something the market wants to look at, especially because the market's been in a bit of a pause for the last sort of few days. There's no data, and the market is becoming a little sort of, I don't want to say bored, but really waiting for concrete information about the tariffs, and not simply, Trump, writing on posters or Twitter or a Truth Social or anything like that. Now, in terms of other stuff, just going back to some of the charts here, just want to look at, we just had a bit of a headline from oil. Well, I don't know if it's a headline, essentially saying that OPEC Plus, or just go into the oil chart here. OPEC Plus, basically sort of headline rumors coming out that maybe from October they will pause their production increases. So who knows if, they're starting to get worried. What we did see is that, oil here is in the trading range. So if we just go back a few months here, let's just put it into context. You can see this sort of a pink lilac box here. That's essentially where there's been a lot of volume and a lot of trading going all the way back to, 2024 here. And basically what's happened is that the market sort of pushed lower, and it's now just creeping back into that sort of trading range. I don't particularly see any reason why this should sort of rocket higher, apart from geopolitical sort of events. On the other hand, I think the oil market seems to be broadly balanced, so I don't see any particular reason for this to collapse. So, which is a boring thing to say, but that's just the way it is. What we had yesterday with the Department of Energy numbers, we had a higher than expected build, so that's not great. But then again, you could put that together and look at the inventory numbers, which I think I showed a couple of days ago. At this time of the year, seasonally in the US, the inventories are actually quite low, so that's a bit bullish. So upon its conflicting signals there again, it seems that, we just had an OPEC report coming out as well this morning. Essentially, they're lowering their forecast for oil consumption for, I think, 2026, 27, 28, 29. So that's a little bit bearish, but again, they're also saying that's not peak oil and they expect that to pick up. So for sure, there's sort of different currents. I think oil at the moment, it looks, as you can see here, this is the 200-day EMA. It looks to be sort of capped at that just for the moment. And I think, to be honest, the boring thing is that oil will probably just trade in some kind of range here from, let's call it maybe $70 down to sort of, 65, 66 at the moment. It will need more information, maybe a resolution or otherwise with tariffs. It's going to need more information about sort of CPI, and it's going to need more information about the general state of the global and the US economies. And I think really what's going to happen is that we have to settle in for a summer where slowly we're going to accumulate information about the tariffs and the global economies, and the various markets will make their choices based on that. VIX is very low, as you can see. So the VIX has come in, it's getting lower and lower and lower. Essentially that's, sort of a modest sort of positive in terms of vol control funds and whatnot. So you see here that the ES mini futures, they're not really ripping, but they're grinding higher. So it's almost like a carry situation here. You just sort of, go along the VIX. And that just seems to be sort of grinding higher, again, without any particular sort of, sort of catalyst up or down. But what I would say is, I think the possibility or the chances or the probability of some kind of dramatic fall are quite minimal at this point. Could this drift back down and test the 6150 level? Yeah, for sure. But at the moment, we'll have to, wait until we get earnings and, more tariff clarifications and more data. It's always the same story. Similar thing with the currencies. You see the US dollar, one could argue it had a bit of a bounce, but already, this morning not doing much. Again, capped basically at the 20-day EMA. This sort of downward trend still seems to be a bit of a barrier for it. And as you can see, just slightly longer term, the momentum here is all still to the downside. All of these moving averages. I mean, you could argue that the 20-day EMA is flattening out a little bit, but essentially the trend is still, until otherwise sort of confirmed, is still to the downside. So that's really what's happening. There's a lot of attention on copper in the last couple of days. It hasn't fallen off. It's the same old thing. I've been reading stories that traders are trying to get sort of physical copper in any way they can into the physical United States before there's sort of some sort of a definite sort of a tariff imposed on copper. So we're hearing stories of shipments of physical copper being diverted to Hawaii and Puerto Rico, which is sort of U.S. territory, in order to get them on U.S. soil to not have to pay any potential sort of tariffs, and if the tariffs go up, to sort of get a sort of a premium. So there's that kind of thing happening. But as you can see here, the big move happened on that sort of Trump comment. At this point, the market seems to be sort of just trading, just off those highs, just in a range, awaiting further developments. What I would say is that BTC is breaking out almost to new highs here. You see that Bitcoin has already tested the high here. This is bullish. So if anything, if some people like to use BTC as a sort of a risk or sentiment indicator, if anything, this is signaling a positive sentiment, a risk-on sentiment, and possibly one could extrapolate that a little bit of distrust in fiat currencies, debasement of fiat currencies, and specifically the US dollar, for sure, which would tend to indicate that probably something like gold, although it's had a very good run and is having a little bit of a pause, as you can see here, having a little bit of a pause. There's no real structural reason which I can figure out which would cause gold to sort of collapse, so to speak. So at this point, it could just be having a bit of a sort of a summer break, just having a little bit of a pause here. What I would say, just in terms of gold, though, if we actually look at it, the spot price on US dollars, you can see here that the EMAs are starting to flatten out at the top, the 20 versus the 50. They are definitely starting to sort of move towards a crossover situation here. So there's a sort of a sideways triangle kind of consolidation here. Could just be summer low volatility. But if you compare on the euro, price to euro, has been a sort of a weaker price action. So part of the gold story, let's keep in mind here, that's gold versus US. This is gold versus the euro. So part of this story of gold strength is a debasement of the US dollar. So not only global concerns, but specifically a US story about sort of fiscal dominance. Is lingering inflation concerns based on tariffs, and possibly also a little bit of less independence for the Fed. Because just by the way, we also have continuing tweets from Trump. I think yesterday he tweeted again, basically saying that too late, Powell had to go. Interest rates needed to be at 1%, et cetera, et cetera. So the point is that gold is hanging in there quite nicely against the US dollar, a little less so against the euro, as we're saying, but I think even against the US dollar, it's still looking quite good. So just finally, just to look at what's coming up. So if we look ahead to next week, as I say, the main interest is going to be on looking at the data, because we do get a lot of important data next week. The CPI, we get the PPI. I think we also get retail. No, do we get retail sales? Yeah, the 17th. So so we get retail sales as well. So basically, by the end of next week, or the middle of the end of next week, that's going to probably start shifting the curve in terms of the 2-year yields, and probably also the equities to a certain degree, but probably the dollar as well, because we'll start to get more and more data as to whether the big debate, is inflation being increased because of tariffs or perceived tariffs effects, or not really. So, again, it's just going to be sort of a slow grind for the next 2 or 3 months, just gathering the data, and the market will react accordingly, especially something like the Fed funds futures or the SOFR or the 2-year yield will definitely sort of be reacting to that along with the dollar. Okay, guys, don't want to speak too much because there isn't a huge amount to say. Have a great day, and we'll keep this going tomorrow. Thank you.